This is the solution to problem 2-25 in your Zelman book. We are going to go over the accounts for non-profit entities, which is different than for-profit. And so we're going to start this problem by identifying what type of an account this is, which statement it belongs on, and whether the balance is a debit or credit. So the first account we're going to start with is provision for bad debt. What this account is it's a reduction to our revenue, because we know when we accrue for revenue, when we debited accounts receivable, credited revenue, that some of that we're not going to get. We're going to have to write that off to bad debt. And so what provision for bad debt does is it reduces our revenue account. So one thing that you could call this would be a contra revenue. And what I'm going to end up doing is sorting this. So we're going to call this a revenue, and we're going to know that revenue is on which statement. You have two choices here. There's the balance sheet, and what we had been calling the income statement in non-for-profit entities is the statement of operations. So typically our revenue would have a credit balance, right? Revenue works like liabilities. Liabilities are on the right-hand side, or liabilities increase our equity, and so on the right-hand side. But because we said provision for bad debt is a contra revenue account against the revenue, it would have a debit balance. Next is our cash. So we know cash is an asset, and so that would be on our balance sheet, and that would be a debit. Patient revenues is a revenue account, right? So that would be on our statement of operations, and this time it would be a credit balance because it's regular revenue. Net accounts receivable is an asset. That's on our balance sheet, would be a debit. Ending balance temporary restricted net assets. So in a not-for-profit entity, we don't have the equity section, or we have the equity section, but it's called something else. It's called net assets. And when we use the term net, we have something less something is net, right? So when we talked about net income, revenue less expenses is net income. Net assets is our assets less our liabilities equals our net assets. Because in a not-for-profit entity, we don't have equity because there's no shareholders. Nobody owns the company. The company operates for the benefit of either the state or another entity, another nonprofit entity. And so here our ending balance of temporarily restricted net assets is $15,900. So that is going to be a net asset. And net asset works like equity, and so it would be a credit balance, and that would be on our balance sheet. A little bit about temporarily restricted net assets. So what is that? So let's say I give $100,000 to Regis College, and I say, here's $100,000. You can only use that to outfit a new computer lab. And so I have put a restriction on that money. So when Regis gets that money, let's think about the journal entry that they may make, or that they would make. Right? So how do I give them $100,000? Right? I would give it to them in cash. So they would debit cash $100,000. So our credit is going to be to net assets, or temporary restricted net assets. And that's going to be our credit. And this is a balance sheet account. So this is on the balance sheet, this is on the balance sheet. So there is no expense or revenue recorded at the time when I give that money. So let's say a couple months later, Regis now is going to build out the computer lab. And so they do an entry, right? So they're going to have computer expenses, let's say. Everything is under $5,000. They're not going to, or each item is under $5,000, they're not going to capitalize it, so they have computer expenses of $100,000, and then they credit cash, right? So they have to pay for it. But now we still have on the books this credit to temporary restricted net assets, so we need to get rid of that because we no longer have this temporary restricted net asset. So how we do that is we record income, or revenue rather, which we're going to call net assets released from temporary restriction. So that's going to be our revenue. So that's actually going to be a credit. And our debit is going to be to temporarily restricted net assets. Right here we had a credit balance of $100,000, so we have to get rid of that. We get rid of that by debiting that by $100,000. So to recap, we pick up the income by crediting the account net assets released from temporary restriction, and our debit is to temporarily restricted net assets. Okay, so here we went over that, and so down here, net assets released from temporary restriction, $2,100, right? What type of account is that going to be? That's going to be a revenue. That's going to be on our statement of operations. So it would be a credit balance. All right, let's go back up here. Wages payable. What type of account is that? So that would be a liability. It would be on the balance sheet and would be a credit balance. Inventory is an asset. It's on the balance sheet. It would be a debit balance. Long-term debt is a liability. Be on the balance sheet, would be a credit balance. Salary expense. So remember, anytime we see expense, that would be an expense. And so that would be on the statement of operations, and an expense is a debit. PP&E, we should know, is an asset. It's on the balance sheet as a debit. Depreciation expense is an expense. On the statement of operations is a debit. General expense, anytime you see expense, you should assume it's probably going to be expense. Statement of operations, a debit. Transfer to parent corporation, we're going to ignore. We're not going to do that here, but basically what that is it's a reduction of the net assets. It's a reduction of your equity. This one, beginning balance of unrestricted net assets. This is a little bit of a trick in that we haven't gone over this. And when we're doing the balance sheet or the income statement, we're looking at the balances as of the end of the period. So we don't really care about the beginning. We're only going to focus on the ending balance. So we're doing nothing with that. Next, we have our accounts payable. We know that that should be a liability. We're going to pay somebody. That's part of the balance sheet. And so it would have a credit balance. Similarly, the beginning balance of temporary restricted we don't care about. We only care about the ending balance. Interest expense is an expense. It's on the statement of operations, and so that would be a debit balance. Labor expense is an expense, again on the statement of operations, debit balance. Accumulated depreciation, we talked about this several times. When we record depreciation, we debit depreciation expense and we credit accumulated depreciation. So we know from that we're going to credit that. And what is accumulated depreciation? It is a contra asset, right? It's against the asset PP&E. So at the end of the period, our PP&E balance, or on the books, is 290 less 35,000. So again, this is a contra asset. I'm going to list it as an asset because I'm going to sort these in a moment. We want to keep things together. So that's also on the balance sheet. Our long-term investments are an asset. On the balance sheet would be a debit. And finally, ending balance, unrestricted net assets. So unrestricted net assets, if you think about it, is like what a type of account for in a for-profit entity. So it's like retained earnings. And so here, our unrestricted net assets is part of our net assets, and it's on the balance sheet, and so it would be a credit balance. So I don't like that this isn't all aligned, so we're going to click over here and make that like that. Okay, so next what we're going to do from here is we need to do our balance sheet and our income statement. So in order to do that, I think it's easiest to sort these, which is why I went through this exercise and put in the type and the statement. And so we're going to do a custom sort, and we're going to do 2 levels because we're going to first sort by the statement, D, and then we're going to sort by the type, column C. So here we have all of our assets and liabilities and net assets. This is going to be our balance sheet. And then here we have our statement of operation accounts. All right, so let's do our assets. Copy, let's paste that down here. Get rid of the color. Okay, so the name of our organization is Lower Merion Hospital, or Upper Merion. And this is our balance sheet. And this is as of 9/30/201X. So here we have our cash, net accounts receivable, inventory, and then we have our long-term assets. So here we have, let's put in a couple lines so we can do this a little bit better. So our first subject or topic in our balance sheet is our assets, so we're going to have current assets. And here we'll have total current assets. Add that up. So our total current is 74.9. We don't need these lines up here. So we'll get rid of this, this, and this. Okay, looks a little better. We'll get rid of that in a minute. And then we have our long-term assets, or non-current assets. Oops, it should be long-term assets. So you saw how it came up automatically because it found the term long-term investments below. So here's our total long-term assets, or total non-current assets, whichever you want to call that. So we have a little bit of a problem here in that our accumulated depreciation, remember that's a contra asset, so that should be a subtraction. So we want to subtract that. And we know that because if we look above here, we had this as a credit balance. So here's debit, credit. So debit would be positive, credit here would be negative. So here's our total assets. $449.9. Okay, so what's next? We need to do our liability section, right? Liabilities. So let's go back up here, and we see our liabilities are these 3. Okay, let's get rid of the blue. Okay, so we know long-term debt, long-term by the nature of the description, is not going to be current. So we're going to move that down here. So we need to do our current liabilities. So we have current liabilities and then long-term debt. Since it's itself, we don't need to put a label there, but here's total long-term liabilities or non-current liabilities. It's 143. So here we'll have total liabilities. And then the next section is our net assets. And we have 2 of those, right? So copy that, paste here. So total net assets. So here we have total liabilities and net assets. $449.9. So we match, right? We equal. So one of the things that I would like to do is make sure all of our fonts are the same and our things are the same size. So here we can do that. And that's the solution to number 225 Zelman.